Hi friends, hope you all are staying safe and keeping well. I'm CA Priyanka Wazirani and we have created this short video to understand the accounting treatment for liability arising on account of corporate social responsibility or CSR as we call it, pursuant to the company's CSR Policy Amendment Rules 2021. The Institute of Chartered Accountants of India or ICAI has recently issued an FAQ to clarify the accounting treatment for such liability. But in this video, we'll also try and compare such accounting treatment with that prescribed under the company's Indian Accounting Standards Rules 2015 as amended from time to time, as well as with Conceptual Framework for Financial Reporting under Indian Accounting Standards, which was issued by the ICAI. Friends, I'm going to start off by giving a quick overview of the requirements of Section 135 of the Companies Act 2013, which deals with the corporate social responsibility. As per these provisions, the board of every company meeting the net worth, turnover, or net profit criterion during any of the three preceding financial years shall ensure that the company spends in every financial year at least 2% of the average net profits of the company made during the three immediately preceding financial years in pursuance of its CSR policy. In simple terms, any company that meets the specified targets mentioned in subsection 1 of section 135 and which has made profits in the past 3 years in aggregate has no realistic alternative to avoid spending 2% of the average net profits of the past 3 years. Therefore, taking the example appearing on your screens, a company that has made net profits in financial year 18-19, 19-20 and 2021 with average net profits of the 3 years being rupees 1000 crores is obliged to spend rupees 20 crores on CSR in the financial year 21-22. The amendment to Section 135 on 22nd of January 2021 now requires the companies to additionally deal with the unspent amount at the end of the financial year in a stipulated manner by transferring the same to specified accounts depending upon the fact whether such unspent amount relates to an ongoing project or not. It states that any amount remaining unspent pursuant to any ongoing project shall be transferred by the company within a period of 30 days from the end of the financial year to a special account in any scheduled bank to be called the unspent corporate social responsibility account. And if the unspent amount does not relate to any ongoing project, the company shall transfer such unspent amount to a fund specified in Schedule 7 of the Companies Act 2013 within a period of 6 months of the expiry of the financial year. As per the frequently asked question issued by the ICAI, the obligating events arise as and when the CSR activities are being undertaken during the financial year in accordance with the CSR policy and projects approved by the board of directors of the company and on the determination of the unspent amount as at the end of the financial year. For the unspent amount, a legal obligation arises to transfer to the specified accounts, be it unspent CSR account or the fund specified in Schedule 7, depending upon the fact whether such unspent amount relates to ongoing projects or not. Accordingly, expense would be recognized in the statement of profit and loss as and when the company does the spending. For the unspent amount, liability should be recognized at the end of the financial year, which is financial year 21-22, as per the case that we have considered in the previous slide. Further, as per Ind AS 34, which deals with interim financial reporting, CSR obligation will be recognized based on the same principles for recognition as used in the annual financial statements. The FAQ proposes the accounting based on when is the company incurring the CSR expenditure and when is it required to transfer the unspent amount to the designated account. In other words, the FAQ regards the incurrence of expense and transfer of unspent amount as the obligating events and postpones the recognition till the time of such spending and transfer. Therefore, it seems that a company can easily manage its quarterly results by spending more or less amounts in the quarters and recognizing the liability for unspent amount at the end of the financial year. Moving on your screens you can see the issues addressed by Appendix C of Ind AS 37 to clarify the accounting for a liability to pay a levy. It clarifies certain key points. Number one, the obligating event which gives rise to a liability is the activity that triggers the payment of levy, which in the case of CSR liability is the time when the company believes that it has generated profits in 3 preceding financial years in the aggregate. So going back to our example, if at the beginning of the fourth year, FY 21-22, it can be concluded that in aggregate the company has generated profits in the last 3 years, FY 18-19, 19-20, and 20-21, then the obligating event arises right on the first day of FY 21-22. It has been clearly stated that there is neither the concept of recognition of liability due to a constructive obligation which is triggered simply by the compulsion to continue to operate in a future period, nor the going concern assumption would imply that a liability should be recognized as the entity has no realistic alternative to avoid spending in the future period. So while the company becomes aware of the fact that it has generated profits in the 3 preceding financial years at the end of FY 2021, just because it has prepared the financial statements on going concern basis of accounting and thus cannot avoid spending those 2% of net profits in the next year, it does not mean that the CSR liability should be recognized in FY 2021 itself. That's what this Appendix C states. Friends, it has also been clarified in the Appendix C that only if the obligating event occurs over a period of time, the liability can be recognized progressively. As regards the interim financial reporting, Appendix C states that the liability should be recognized in the interim period if the obligation to pay exists at the end of the interim period. In a nutshell, as per Appendix C of Ind AS 37, the liability must be recognized on the first day of financial year 21-22. However, the FAQ postpones the recognition till the incurrence of the expense for the amount that the entity spends during the year, and for the unspent amount, it postpones the recognition of liability by 1 year, that is, to the last day of financial year 21-22. Friends, let's now have a look at the requirements of the conceptual framework for financial reporting under Ind AS, which is issued by the ICAI. Going by the framework, the liability must be recognized at the end of the third year, that is financial year 2021, if the company uses going concern basis of accounting. This is because the entity's responsibility to transfer the economic resource, which in this case is payment of CSR liability, could be avoided only by ceasing to operate, which is untrue when the financial statements are prepared using going concern basis of accounting. The conceptual framework regards having profits in the current year and past 2 years in aggregate as the obligating event and requires recognition of liability the moment the company does not have any practical ability to avoid that obligation. Friends, clearly the requirements of the conceptual framework on trigger of the obligation simply due to the entity following going concern basis of accounting is not consistent with the clarity given in the Appendix C of Ind AS 37 that we just discussed in the previous slide. On your screens is the summary of the difference in the timing of recognition between the requirements of the FAQ on accounting for amounts to be incurred towards CSR, of Appendix C of Ind AS 37, and of the conceptual framework for financial reporting under Ind AS. Friends, here you can see the impact on the financial statements for the year ended March 2021, quarter ended June 2021, and year ended March 2022 under all the three scenarios. Ind AS 1 on the presentation of financial statements specifies that the objective of financial statements is to provide information about the financial position, financial performance, and cash flows of an entity that is useful to a wide range of users in making economic decisions. In our view, by following the conceptual framework, an entity can provide the most appropriate information to the users of the financial statements in accordance with the requirements of Ind AS 1. Whereas, by following the FAQ, an entity would provide the least appropriate information and not meet the objective specified in Ind AS 1. Do let us know in the comment section your views on which of the three would result in providing the most useful financial information about the reporting entity for decision making of the users of the financial statements. Friends, we hope you liked this video. Please subscribe to Gap Advisors for more such videos. Thank you. Happy learning.